Welcome to the Opening Bell Report.
So I was looking at the market movers this morning, and I saw a number that, honestly, it made me do a double take.
Oh, yeah.
I thought my screen was broken. Seriously. You see revenue growth of, 10%, you're happy.
Yep.
50%, you're, popping champagne.
Sure, that's a great quarter.
But this company, ImmunityBio, ticker IBRX,
Okay.
is showing revenue growth of over 1,000%.
1,000. Wow. Okay, that's not a number you see every day. That's the kind of thing that puts you in the four-digit club.
It just stops you in your tracks. And it demands an investigation. So that's our mission for today.
A deep dive.
A deep dive into ImmunityBio. It's Thursday, January 29, 2026. The stock is trading right around, call it $5.91, down a tiny bit today.
Yeah.
But the narrative, the buzz, is deafening.
Mm.
And we've got this comprehensive analysis report in front of us. It's titled The Anketiva Commercial Breakout.
And breakout is the right word. But the real question is it a breakout that lasts, or is it more like a flare-up that just burns out?
Exactly, because when I see 1,000% growth, my skeptic brain it immediately turns on. I want to know, is this real? Is it sustainable?
Right.
And has this company actually graduated from being a science experiment into a real business? Because looking at the timeline in this analysis, they barely survived to get here.
That is putting it mildly. The report actually categorizes their history into phases, and 2023 is labeled the dark days.
Okay, how dark are we talking?
We're talking lights out dark. The stock was under $2. They had zero, and I mean effectively zero, revenue.
Wow.
They were just burning cash like a furnace. Investors had pretty much left them for dead. It looked like another biotech tragedy, The science is fascinating, but the money runs out.
So that's 2023. We're sitting here in early 2026. That is an incredibly short window for a turnaround. How on earth did they pull out of that nosedive?
Well, 2024 was the catalyst. That's when the FDA finally stepped in. In April of 2024, they got approval for their flagship drug, Anketiva. And that single moment changed the company from a maybe to a yes.
Okay, so they get the green light. But approval doesn't always equal sales, right?
Yeah.
We've seen plenty of drugs get approved and then just flop.
That's true. But 2025 was the execution. This is where they went from generating maybe $1 million a quarter.
Which is nothing in biotech.
It's accounting error territory. They went from that to pulling in over $30 million a quarter.
And that gets us to 2026, the proof.
Exactly. That 1,000% revenue jump isn't a projection anymore. It's the receipts. It proves doctors are prescribing it, patients are using it, and crucially, insurance is paying for it.
All right, before we get too carried away with the financials, I want to understand what this thing actually is. What are they selling? Because if the product is mediocre, the chart eventually collapses. What is Anketiva?
It's an immunotherapy drug. But to really get why it matters, you have to look at what it's replacing. For so long, the standard for cancer treatment was just chemotherapy.
Which is effective, but is brutal.
It's carpet bombing. You kill the cancer, sure, but you destroy a lot of healthy, civilian cells in the process. Anketiva is different.
How so?
Well, the technical term is an IL-15 superagonist.
Superagonist. Okay, that sounds like a Marvel villain or maybe a really intense personal trainer.
Right, it does. But in this case, it's the commander on the battlefield. Instead of attacking the cancer directly, Anketiva activates the body's own natural killer cells, NK cells, and T cells.
Wait, natural killer is the actual medical term for them.
It is, and they really live up to the name. They are white blood cells that are basically designed to hunt down viruses and tumors, so Anketiva wakes them up, boosts their numbers, and directs them toward the cancer.
So it's not the bullet, it's the general giving the order to attack.
That is a perfect way to put it. It's training your own biology to do the job. And right now, its approval is very specific. It's for NMIBC, non-muscle invasive bladder cancer.
That feels incredibly specific. Is that a big enough market to justify all this hype?
It's a significant market for sure. But the real key is that this approval validates the platform. They prove they can take this theory about natural killer cells and turn it into a real commercial product. That shifts them from an R&D lab to a commercial entity.
Got it. Okay, so the science is validated. Let's circle back to my skeptic brain and that 1,000% number. You and I both know you can make statistics say anything. Is this just a base effect?
You hit the nail on the head. It is largely a base effect. If you made $10 last year and $100 this year, you grew 900%.
Right. It sounds massive, but you've still only got $100.
Exactly, because they were making basically zero in the dark days. Any pulse looks like a massive spike. The analysis report is upfront about that. The 1,025% figure is accurate, but it's looking in the rearview mirror.
So what's the honest number? If I'm looking at the health of the business right now, what should I be focused on?
You want the quarter-over-quarter growth. How much are they growing every 3 months? And that number is sitting at a very steady 20%.
20%.
Yeah.
Every quarter. That's really healthy.
It's kind of the Goldilocks zone. It's fast enough to compound very quickly. You're basically doubling your business every year, but it's stable. It suggests organic demand.
It tells me they aren't channel stuffing.
Exactly. They aren't just shipping pallets of drugs to a warehouse to book the revenue before anyone actually buys it. This looks like real pull-through from the market.
Okay, let's talk real dollars. What does this 20% growth translate to?
For the full year 2025, the preliminary revenue is landing around $113 million. For context, in 2024, that number was $15 million.
That is just a vertical line on a chart.
It is, and for Q4 2025 alone, the estimate is about $38 million.
And what about margins? Usually when you ramp that fast, things get messy, they get expensive, you're hiring people, building out infrastructure.
Surprisingly, the margins are pristine. We're talking gross margins between 80 and 84%.
That's software territory. That's a tech company margin.
It is. Once you've done the hard R&D, the actual cost to manufacture a dose is low compared to its price. That high margin is the lifeblood of biotech. It's what funds the next drug.
Okay, so high growth, high margins. But they aren't the only ones playing in this space. When I think bladder cancer, I don't think ImmunityBio. I think of the giants.
You're thinking of Merck?
Exactly, the pharmaceutical titan.
Merck has a drug called Keytruda. It's an absolute blockbuster. It completely dominates this space.
So is this a David and Goliath situation? Is ImmunityBio trying to take down the giant?
See, that's where the strategy gets really clever. They aren't trying to kill Goliath.
Okay.
They're cleaning up after him.
What does that mean?
ImmunityBio is approved for a very specific niche. BCG unresponsive patients. These are the people who took the standard treatments like Merck's Keytruda or BCG therapy, and it didn't work for them.
Ah, so they aren't fighting for the same patient on day one.
Not at all. They are waiting for the patients who have run out of options. It creates a protected niche with virtually zero immediate competition, because if you're taking ANKTIVA, it's because the other stuff already failed.
That's a very smart strategic wedge. You let Merck do the heavy lifting, and you take the high-value cases that slip through the cracks.
Exactly.
But does the stock price reflect that they are a cleanup crew rather than the market leader?
And this is where the risk starts to creep in. You just have to look at the valuation multiples. Merck trades at about 5 times its sales. It's a mature, stable battleship.
Right.
ImmunityBio, it's trading at 33 times sales.
33, wow.
Yeah.
That's expensive. That is priced for perfection.
It's a massive premium. The market is betting that this 20% growth never stops. They're pricing in the future today. They're saying, we don't care what you sold yesterday. We care what we think you'll sell in 2030.
And that brings us to the part of the report that made me a little nervous. We've talked about the rocket ship going up. Yeah. We need to talk about the fuel tank. Yeah. Because reading the bottom line, it looks like there's a leak.
It's more than a leak. It's a hole. Despite all that incredible revenue growth, the company is still losing a tremendous amount of money.
Give me the ugly numbers.
Operating income is negative $260 million. Net income, negative $340 million.
So for every headline about record revenue, they're actually just digging a deeper hole in the bank account.
Commercialization is incredibly expensive. You've got the sales force, the marketing, distribution, the burn rate, the cash they spend just to exist is about $70 million every single quarter.
And how much do they have in the bank?
As of the last check, about $242 million.
I can do that math. 240 million divided by 70 million a quarter. That's what, 3, maybe 4 quarters? That's a very short runway.
It is. And when the runway runs out, you have 2 choices. You crash or you find more money.
And on the stock market, finding more money usually means one thing.
Dilution.
The dreaded D word. For anyone listening who hasn't been through this, let's just quickly explain what that feels like.
Yeah, imagine the company is a pizza. You own 1 slice. When the company needs cash, they don't sell more pizza. They just slice the existing pizza into thinner and thinner pieces to sell to new people. The pizza didn't get any bigger.
But my slice just got a lot smaller. My share of the company and the value of my stock, it drops.
That's the mechanics. And the report predicts a secondary stock offering is pretty likely in mid-2026. So if you're an investor, you are staring at a calendar knowing dilution is probably coming.
There was one metric in the analysis that really highlighted this, the cash flow to sales ratio. It was negative 250%.
Yeah. I mean, in plain English, for every $1 they bring in from selling the drug, they are spending $2.50 just to keep the lights on.
That is just, it's completely unsustainable. You can't run a business or a household spending $2.50 to make a buck, not forever.
You can't. Now, to be fair, the report does note this is a huge improvement. Last year, that number was negative 5,000%.
Okay, so they are moving in the right direction. It's less of a disaster than it was.
It is. But it's a race. Can they grow sales fast enough to stop the bleeding before they run out of blood? That is the fundamental tension with this stock.
So given that tension-high growth versus the cash burn, what are the analysts saying? Is this a buy or a sell?
It's a mix, but the consensus is a moderate buy. You've got 5 analysts saying buy, 1 hold, and 1 sell.
And what about price targets? We're at about $5.91 today.
The average target is $11.80, so the street thinks this thing could double. The bull case goes all the way up to $24.
That's a quadruple.
That's if everything goes right. They keep that 20% growth, they avoid a disastrous dilution event. But the bear case, if sales plateau or the financing gets messy, sees it dropping to $3 or $4.
There's one other wild card here I wanted to touch on, short interest. The report says it's around 14%. That seems high.
It is high. That means 14% of the available shares have been borrowed and sold by people betting the price will crash. They're betting on that cash burn. They're looking at that balance sheet and saying, this company is going to run out of money.
But that can backfire, can't it?
Oh, big time. It creates a short squeeze setup. If ImmunityBio drops some good news, say they beat revenue expectations again, the price jumps, all those short sellers suddenly start losing a lot of money and they have to rush in and buy the stock to close out their position.
Which just drives the price up even further.
It's like pouring gasoline on a fire. The negativity can, paradoxically, fuel a massive rally if the company executes.
So we have a company with a working drug, explosive revenue, but a ticking clock on cash. It really feels like they are at a crossroads.
They are. But there's one final piece to this whole puzzle. The report hints at it, and I think it's maybe the most important thing for you to think about.
What's that?
It's not about bladder cancer. It's about lung cancer.
Lung cancer. Explain that.
Right now, the market values ImmunityBio based on the bladder cancer market. It's a nice business, a good niche, but it's limited.
Okay.
But remember the science. We said ANKTIVA activates the immune system to kill tumors.
Right. The general doesn't care who the enemy is.
The mechanism shouldn't be limited to the bladder. Theoretically, this should work on other solid tumors. And if they can prove this works for lung cancer, which is an exponentially larger market, then the whole math changes.
Then they aren't a niche company cleaning up Merck's leftovers. They become a platform technology.
Precisely. The current valuation of $5.8 billion assumes they succeed in bladder cancer. But if that lung cancer data comes back positive, that $24 price target might start to look cheap.
But if it doesn't?
If it doesn't, then they're a one-trick pony with a very high burn rate.
A universal key for the immune system. That really is the gamble. We'll be watching those clinical trials very, very closely. That wraps up this deep dive. Thanks for listening.
Don't forget to like, share, and subscribe for more.